Hi, welcome to Geojit Spotlight. In the last financial year, the Indian stock market was very volatile due to COVID and war. Dr.V.K. Vijayakumar is sharing the outlook of the Indian stock market in the new financial year. Welcome, Dr. V.K. The economy has been subjected to various shocks in a short span. First the COVID and then the war in Ukraine. How is the economy responding?
Nifty is all set to deliver 18% returns for FY22. Coming on top of the 71% returns delivered by Nifty in FY21, these are very impressive returns. The broader market has outperformed with the returns of around 35%. The economy is smartly recovering from the contraction triggered by the pandemic. In financial year 21, the GDP contracted by 6.6% as per the revised estimates of the CSO. This financial year 22, the GDP is expected to grow at around 8.5%. And for the coming year, financial year 23, GDP growth projections at the beginning of this year was above 8%. But then the war in Ukraine has dealt a blow to the economy, to growth as well as inflation. This year, growth will be slightly lower and inflation will be higher than initial estimates. It has been estimated that for every 10% increase in the price of crude oil, GDP will decline by 0.2%. And inflation will rise by about 0.4%. 10% increase in crude will widen the current account deficit by 0.3%. And we know crude has spiked from $75 at the beginning of this calendar year to above $100, and then it reached a peak of $139 in early March. And now it is hovering around $110. So this higher crude will certainly impact growth and aggravate inflation. But how severe the growth impact will be, how severe will be the impact on inflation will depend on how long the crude prices will remain elevated.
What are the sectors that are likely to do well in this financial year?
Among sectors, financials appear most promising. Financials, particularly leading banks, both in the private sector and the public sector, particularly in the private sector, then leading housing finance companies, the leading fintech company, all these are set to increase their profitability in the coming year. Credit growth is improving. Asset quality has improved substantially with sharply declining NPAs, and all the leading banks, particularly in the private sector, are very well capitalized. So banks are set to gain from the economic recovery and the sharp pickup in credit growth expected for the coming year. Actually, the prices of banking stocks have been depressed not because of any fundamental problem with the banking stocks, but because FIIs have been selling banking stocks relentlessly. They have been selling relentlessly, and bulk of the selling happened in banking and IT stocks. So the prospects for financials look very, very promising. IT also has very good prospects going ahead. Actually, IT is in a 3 to 4 year expansion cycle. Digitization of business is happening at a very fast pace. Migration to cloud is happening at a faster rate than expected. So this means the prospects for IT companies look good for the next 3 to 4 years. But the problem with IT stocks is that the valuations are very high. There is no comfort in valuations. For most of the leading large IT companies, PE multiples are about 30. And for a large number of mid-cap IT companies, valuations are much higher than that. So valuation is a concern in IT, but growth prospects and earnings visibility are very, very good. Construction-related segments continue to do well. Of course, there is some problem with cement companies. The increase in the price of coal is likely to increase the cost of production of cement and reduce the margin a little bit. But the low interest rate regime is a very good tailwind for construction-related segment. Telecom is one segment which is doing very well and is likely to do well in the coming year also. Pharmaceuticals and specialty chemicals are on a very strong wicket. FMCG is likely to be under pressure because increase in the price of crude will increase the cost of packaging, and also the increase in the price of edible oils will depress the margins of FMCG stocks. Already FMCG stocks have responded negatively to increase in crude prices.
What are the biggest challenges that the Indian stock market will be facing in this financial year?
More often than not, the problems to the market, challenges to the market arise from unknown factors. At the beginning of this year, a war in Europe was not in the radar of any fund manager or market analyst. The war was not discounted by the market, but then suddenly the war broke out. Just like that, some unknown factors can emerge, unknown challenges may emerge. We don't know that. The real known challenge now, and there is a big challenge, is the persistently high inflation in the US. Inflation in the US is around 7%, which is a 40-year high, and the Fed, the central bank of the US, the Fed, is tightening monetary policy. Their bond buying program was stopped with this month, March, and they have already raised the interest rates by 25 basis points, and the market expects a total of 190 basis points increase in interest rates in calendar year 2022. So one or even 50 basis points increase in interest rates cannot be ruled out. This is a negative, certainly a negative for equity markets globally. Money will move from equity to bonds, and the rising bond yields will lead to more investments in bond and a migration from equity. But how severe it will be will depend on the prospects for economic growth, how fast the global economy will recover and earnings will recover. Coming to India, if the war does not prolong, and if the crude prices do not remain elevated for long, India can easily achieve a 7.5% GDP growth and a nifty earnings growth of around 18% for FY23. This will augur well for a nifty index also, but we need expect only modest returns for FY23 since the challenge of rate hike, sustained rate hike by the Fed is a major challenge for all equity markets and particularly for emerging markets. In India, a very positive development is the explosion in retail demat accounts. Recently, the demat accounts in BSE alone crossed 10 crores. The explosion in demat accounts is unprecedented and a little bit surprising, pleasantly surprising. So this can provide a resilience to the market. Investor enthusiasm. Already FII selling is being absorbed by DII buying and retail buying. So FIIs are not a force to reckon with as they were previously, and the retail investors are now becoming a force to reckon with. This is a very positive development for the market, but investors have to be careful. They have to be selective in investment. They have to invest in high quality stocks. Investors need not be completely focused on sector and sectoral performance. It is important to appreciate the fact that 80% of India's corporate profits come from top 20 companies. These 20 blue chip companies with an excellent track record in financials, in IT, in oil and gas, in FMCG will continue to do well. So investors can look beyond the sectors and focus on the high quality stocks which have a very good earnings visibility. Thank you and best wishes.
Thank you, Dr. V.K. Lot of factors are going to determine the movement of the market in the next days. Thank you for watching. Bye.